Good morning, everyone, or good afternoon if you're coming in from China. We have a special webinar today brought to you by LBMA Webinars. It is called The Chinese Gold Market in the Year of the Ox. We are joined by Jeremy East, the Senior Advisor for Asia from LBMA, Joni Teves, the Precious Metals Strategist at UBS, and Roland Wang, Managing Director for China at the World Gold Council. Before I hand over to our panelists, I'm just going to take you through a bit of housekeeping. So if you have any questions throughout this webinar, please do submit them through the Q&A function at the bottom of your screen. If you can't see that, if you can't use that, if you don't know what I'm talking about, just send an email through to ask@lbma.org.uk, and these will either come through to us on the webinar or after the webinar, and we'll endeavour to get back to you. So without further ado, Jeremy, I'm going to hand over to you.
Thank you, Taylor. Thank you for the introduction, and welcome everyone. So 2020 was a year of change and challenges. Change in terms of physical flows for the last 7 years or more. Gold has been flowing from the west to the east. Last year, 2020, was the year when the tables were turned and gold started flowing from Asia back to London and also to New York. Last year, a year of high prices. Traditionally, high prices are bad for the physical markets. And we saw that in Asia with almost unprecedented discounts for physical bars. Challenges in terms of logistics. We're all very familiar with the challenges of logistics, of shipping gold around the world. But it seemed by the end of the year, a lot of those challenges had been overcome. Activity last year very much driven by the investors who kind of took up the slack which the normal physical markets opened up, with China importing almost no gold, and also India, again, the slack taken up by the investors and investing in the ETF. So looking forward to this year, what's in store? The year of the ox. A good strong start in terms of China. The economy is booming. But will this continue? The PBOC look to be starting to put some shackles or try to control the strength of the market. Maybe potentially draining liquidity, putting in higher interest rates. What's this going to hold in store for China? We're coming in starting the year of the ox at much lower prices. Will these lower prices translate into stronger physical demand? It seems that jewellery demand's coming back in China, and maybe investment not so strong. Also, onshore liquidity. The last time gold started to be a premium in China, there was a lot of tightness in terms of liquidity for gold. Is that the same now? The discounts that we saw last year seem to be moving back towards premiums again. But will that be maintained? So all these questions, I hope, are going to be answered by our experts today. And I'll start by handing over to Roland from the World Gold Council, who's going to talk to us really about the manufacturing side, jewellery demand, investment demand, and the market trends in China.
Thank you, Jeremy. Good afternoon and good morning. Of course, as Jeremy just said, that last year is a year of change and of course the challenges and the difficulties especially in the first part of the year for the China market typically. For the next slides, first slide, please. From the left-hand side, the chart shows that the Chinese economy experienced the large setback in Q1 2020 due to the lockdown, of course, because of the COVID-19. But with the swift the outbreak containment, the nation economic growth kept rebounding after Q1. By end of Q4, Chinese GDP actually has shown a typical V-shaped growth, reached about 6.5% year-on-year growth, and consumption in China and also witnessed a remarkable upticks. As the consumption recovered gradually, Chinese gold demand also revived, of course, slowly, after reaching the lowest level in Q1 in 2020. That's the lowest level since 2008 Q2. Chinese gold consumption started to recover slowly from Q2 2020. By Q4, we have witnessed total gold jewelry bars and coin sales in China return to their 2019's level. And the full year 2020, Chinese gold demand, including gold used in the technology sector and retail investment, and also jewelry, totaled about close to 700 tons a year, a bit lower than 2019. But the year-on-year decline has narrowed down significantly since 2020 Q1. Next slide, please. We have seen one sign of from the weakness in Chinese gold demand in 2020 was the widest among Shanghai and London spot gold price discount in history, averaged even up to 24 US dollar per ounce in 2020. The local Chinese gold price spread remained far below its 10-year average between 2010 and 2019, and recorded the lowest level since the Shanghai Gold Exchange established in 2002. But we recently published a report explaining the drivers behind this such a huge discount. And of course, our analysis shows that the Chinese gold supply shortage, cost association with importing gold, as well as a restriction on gold imports in China, contributed to a local gold price premium during the most days, significantly weakened gold demand, relatively ample gold supply, and the restrictive nature of gold exports could be the main drivers for the record level Chinese gold price discount in 2020. If Chinese gold consumption in 2021 continue to recover, like the picture shows, the Shanghai-London gold price spread is likely to return to its long-term average, which is around about $5 to $6 per ounce premium. But we have seen the premium was back already to about $1 per ounce in January on average, and actually back to $11 even in February on average. Well, mainly because we have the Chinese New Year holidays, and definitely there will be no import actions usually during the holidays. But because of the strong demand from the local market, I think that's one of the reasons why there's such a premium back into the picture. Next slide, please. Of course, our trade partners reported significant year-on-year growth in their Chinese New Year holiday sales. The picture on the right-hand side shows 3 leading chain stores, retail chain stores in China, namely Lao Fengxiang, which is a public company from Shanghai, and below left is Chow Tai Fook, which is a leading chain store retail brands in Asia. It's a Hong Kong brand. And on the right-hand side, it's China Gold Jewellery, which is recently listed on Shanghai Gold Exchange. And from all the information we collected from both manufacturers in Shenzhen and wholesalers nationwide, and as well as the leading retailers' sales during Chinese New Year, they have all reported a very strong comeback from the consumers especially. And there's also a sign of very positive sign that you can see it in from the pictures. We have seen quite a large share of consumers are quite young. And I think just because the sort of innovative product designs provided by the manufacturers and retailers in the past 2 years has shown the positive result out of their effort in the past 2 years. And especially strong sales for the newly popular heritage gold, we call it, and outperforming other categories. Next picture. Next slide, please. Of course, we have seen, besides the picture shows for the strong sales during the Chinese New Year, especially for the gold jewelry sector. But the Chinese gold demand actually is quite diversified. We're both a #1 gold consumption country for jewelry and retail investment. We have also seen a sign of a rapid change of gold jewelry consumption throughout the consistent effort by the gold industry. And we also improved product offering through product innovation. You can see the modern so-called hard gold attracting to the younger generations on the right-hand picture. And the last one, of course, is so-called heritage gold, which is getting very popular. One of the reasons, actually, is quite expensive piece. One of the reasons reported from the consumer says that it shows the matured consumers seems has quite strong consumption power accumulated throughout last year. And of course, throughout the strong performances of equity market, stock market in the past 2 quarters. That is give us a quite strong confidence for the retailers and the manufacturers that they all foresee there will be definitely a stronger consumption this year in China. Next slide, please. We have also seen there's a room for improvement of Chinese gold consumption in 2021. To strengthen the foundations of a steady economic recovery going forward, the policymakers actually stated at the annual Central Economic Work Conference in late last December, stated that the fiscal and the monetary policies will remain supportive, and this could mean a further recovery of consumer disposable income and potential leading to the higher gold consumption. We are, besides the strong demand for gold jewelry, especially in the past 2 months, the retailers and trade reported there also a kind of a sort of a recovery for the retail gold investment products. The government has positioned domestic consumption stimulation plan as a key task for this year and further supporting the Chinese gold consumption forecast. However, the consumption revival in China still face some headwinds this year, and namely the lightweighted trend, the consumer taste shifting from and retailers' strategic increase of lightweighting prices in their stock, basically in Chinese jewelry market, and a high opportunity cost. Of course, the attention grabbing by the hot stock market in China in the past 2 months, especially, might still have provide a strong headwinds in China, namely. So next slide, please. However, driven by the sufficient containment of the COVID-19 pandemic, the economic recovery and accommodation monetary policies, Chinese stock market has rallied, and the CSI 3000 stock exchange, a proxy of Chinese gold stock market, surged by 27% in last year, especially in Q4. But in the meantime, price-earning ratio of top performing sectors and CSI 300 stock index itself has risen to above or nearly their 90% levels, as shown here on the picture, on the left hand picture. Our analysis shows that RMB gold has provided verification benefits to Chinese investors over the past 15 years. When the stock market is rising, the gold correlation with it turns to be positive. When the stock market drops, the correlation turns negative. So it's what we call an effective diversifier. We have seen the investment institutions, even like the insurance asset management companies, started to issue the gold-driven insurance asset management fund to basically try to take advantage from the both gold market and also stock market to attract the more sophisticated, mature investors. And we have also seen there are more asset management products available into the market provided by the commercial banks and by the financial institutions, especially in the past 2 years. So for that, as a base, we have seen that there should be a strong position and for a hope for the stable gold demand in China this year. Definitely better than last year, but whether they can return to the level of in 2019, we have to wait and see for a while. I think that's basically a picture I can show you based on the past 2 months performances in China. Thank you for your attention.
Thank you very much, Roland. Just before we pass over to Joni, I've just got one quick question for you.
Yes.
World Gold Council has keeps a track of all the gold investments in ETFs, and yes. China seems to be on the, I would say on the low side compared to Europe and to the US.
Yes.
What's been happening with the ETFs in China in the last year?
All right. Actually, Chinese local gold ETF has attracted more, not attracted, welcome for a 7 new gold ETFs launched in the last year. And now total local listed gold ETF has reached 13 funds, basically throughout the past years. We have seen the steady growth since the first launch, since 2013 by Huan Gold ETF. And now total accumulated gold have been throughout all the listed gold ETF has reached about 60 tons of gold. Of course, compare with this overall demand for retail gold demand in China and compared to the global figure in the North American and Europe market, China's figure still seems not very high, although it's #1 in Asia already. One of the reasons we've seen is basically in China, consumers has quite wide variety of choices for investment products, physically especially. The commercial banks provide a full range of gold investment products, including we call it a gold accumulation plan and gold bank accounts and all kinds of tradings and services by the banks and also by the institutions. So I think compare with the Western investors, Chinese investors actually has quite wider choice of gold investment products in the marketplace. And gold ETF is a newcomer. And so although it has a lower entry level and also low fees, however, it faces the competition, I would say, from the existing market products. And also its trading hours is listed only within, I think, the three trading hours in daytime. So consumers has, I think, has a wide, a better choice maybe to compare. But I believe with more institutions started to coming into the market, I mean the insurance fund in the future, pension funds, gold ETF definitely is one of the best choices they can invest into gold market in future.
Great, thank you very much, Roland. Now let's pass to Joni. She's going to talk to us about the sort of the gold flows from a more of an international perspective. The impact of COVID, obviously, in terms of logistics, and really I think, you know, if we think we're seeing a return of China to the gold market, the physical gold markets. What are the implications going to be for international players? So, Joni, over to you.
Thanks, Jeremy. So gold demand in China last year was severely impacted by the pandemic, as Roland kind of outlined. A combination of the impact on incomes, economic uncertainty, lockdowns, as well as higher gold prices weighed heavily on consumer demand. There have been signs of a recovery over the past 6 months or so, but this has been quite gradual. Looking at imports and trading volumes, this have remained quite muted. That said, in the lead up to the Lunar New Year holidays, there were signs of a further improvement in demand, and we also have seen indications of physical interest after the holidays, which could signal that market participants are starting to rebuild these stocks after consumers bought gold products over the holidays. We recently did some analysis around consumer demand across key countries and what tends to drive these. And our results confirm, firstly, long-held notions of seasonality in China, wherein Q1 demand tends to be stronger. So it'd be quite interesting to see whether that starts to show up in much better import volumes as well as the data comes out. More broadly, our analysis suggests that demand volume should continue to improve from here as the global economy recovers and incomes grow. What we found is that jewelry demand in particular is positively related to GDP, moving more than proportionally with income. So for instance, if GDP is 1% higher in one quarter versus another quarter, then demand for jewelry tends to be about 1.3% higher. Meanwhile, demand for physical bars and coins are positively related to savings, and this supports the notion that physical gold holdings tend to be viewed as a form of savings or long-term stores of value. So the continued recovery in incomes as a whole and long-term GDP growth should therefore underpin physical gold demand. I think this is important in the long run, particularly in China, to offset changes in consumer preferences, such as the move towards lighter jewelry pieces among younger consumers, that sort of Roland mentioned as well, or other consumer segments such as luxury goods, electronics, and travel. This should also somewhat help offset the potential competition from alternatives as the financial landscape in China evolves and more alternative investments become available. So all in all, our view is that the recovery in physical demand in China and globally should continue this year, and that should provide sort of a better support to the gold market globally than what we saw last year. And I think this is important, especially as so far this year, gold has faced some macro headwinds. I'll leave it there and pass it back to you, Jeremy.
Thank you very much, Joni. I've got a couple of questions that come to mind. Are we, back in 2013, there was a huge amount of gold that actually moved from sort of the ETFs, converted to kilobars and found their way out to China. We're potentially seeing China now coming back to a small premium, sort of $7 to $10. Are we going to see the same flow again? Do you think we'll see investors in the West starting to liquidate their ETFs, or maybe they already are, and we'll see this gold start to flow across to China?
Jeremy, you asked me, or Joni? Joni,
both of you, yeah, fine.
Joni, please. Yeah.
Okay, sure. I'll kick it off. I think the situation now is a little bit different to back in 2013 in terms of the extent of the drop in the gold price, the economic backdrop at that time. And yes, ETFs have started to liquidate positions, but so far the pace of the liquidations are not comparable to the extent that we saw in 2013, at least at the height of the selling in 2013. And I guess the economic backdrop in China as well, and the appetite towards gold is slightly different. So I would say that the dynamics that we saw in 2013 are probably not going to be repeated to the same extent. But I think that the physical demand this year and over the coming year should continue to sort of underpin the broader trends in gold.
Yeah, I agree with Joni's comment, and I also want to add 2 points for consideration. One is I think the Chinese consumers are getting more realistic after they got this, they gained their experiences. Especially we call it the Chinese dama, is housewife consumers. They have spent about I think 5 years to fully recover from what their purchase, and I think they all have learned, and also the media has a lot of report about that. Actually, last year, as the gold price goes back to 1900, above 1900, actually, there's a lot of local report about they have basically make even after 5 years stock in their wallet. However, I agree that Chinese consumers now, if they still have a stronger concern about the possible inflations if they happened, and they will maybe trigger a stronger appetite for invest into the gold, physical gold investment products, I think. But of course now, according to the official CPIs, it haven't shown the strong or rapid increase of the inflation yet. But some of the trade has reported to us that the more consumers has come back to them to ask to advise how can they find a better products to diversify their assets. I think one of the main drivers for the consumers or investors in China is they realize there's a need to diversify their current assets, which majority of them it's in the retail estate. And of course, they from their more knowledge they gain from the market now in the past few years, and I think they will get more knowledge about the special role gold can play in the asset diversification. I don't think that we may see another sharp sort of a strong demand from Chinese demand again in the near future, but I believe the Chinese consumers still have quite sort of a belief and confidence on the gold role in the coming years.
And of course, the flow of gold into China is controlled by a sort of a quota and licensing system that's been in place for many years. I don't know if that potentially might change in the future.
I don't think as long as the RMB is not fully convertible, I think this kind of a quota system will exist for quite a while.
Yeah. Joni, in terms of the flows into China, I think although the premium is coming back up, it seems that the flows are not picking up dramatically. I don't know what you might think.
The import data that we have so far, which is until December, does show that the improvement has been very, very gradual. Potentially, this suggests that there is onshore stocks, and therefore, even with a pickup in consumer demand, there is no need to bring in fresh metal as yet. So I think that's why the data for January and February should be quite interesting to see whether it matches sort of the pickup in interest that we've noticed, especially in the lead up to the Lunar New Year holidays and even in the period after that.
Because China basically is the driver for the region. When China goes back to a premium, then you suddenly start seeing more premiums in Hong Kong and Singapore. So I think it's quite key for the market. If China maintains at a premium, we're going to see, I think, for a kind of a knock-on effect in Asia as being a more positive market. Joni, what do you think in terms of we're starting with low gold prices, which traditionally are better for physical markets?
So I think the onshore premium is really a reflection of the strength of sort of underlying demand. But thinking about how the strength of underlying demand really impacts global gold prices, it doesn't really have that much of an impact. Ultimately, it's investor interest that drives global gold prices. And the one important reason for this is because if you think about the annual physical supply demand volume, it is actually quite small compared to the notional volumes that are traded in gold futures or OTC spot transactions, which these types of trades by investors tend to be driven by macro factors. So conversely, it's really gold physical demand that is impacted more by price. So lower prices, lower gold prices, for instance, in one quarter, what we found tend to translate into 0.6% higher demand for gold jewelry, for instance.
That's a really interesting point. If you look back at last year, we saw record gold prices in a year where we saw no buying from China and no buying from India, the two largest physical markets on the globe, but investment demand drove the prices to all-time highs.
Well, Jeremy, I think that there's another factor to have to consider, especially last year is a unique year. It is not a very common, we can't use a common analysis to judge it, because main reasons that people basically cannot go out for shopping, and also they during that kind of environment, it is difficult for consumers to buy physical gold. I think China is lucky, the mainland China is lucky, so we were more or less back to normal quickly, and so that's why we have seen this recovery. However, on top of Joni's comment about the import of gold, I think one factor has to bear in mind that even though we have a strong demand, definitely is underpinned by that's the premium that shows this. However, we have seen might be a short of supply because of the control of a border transportation, and also especially during the Chinese New Year, you really that is not a right time for people to do the shippings. Yeah.
So Roland, I've got a tough question for you. Okay. Online, we've PBOC have been buyers of gold, although I don't think they published their numbers recently. But they've been quite aggressive buyers of gold, I would say, in the last 5 years. Do you expect them to come back to the market?
Yeah, well, thanks for this. I mean, they stopped publishing the increased number for gold, I think since end of 2019. I believe they have their own strategies, and I believe that the PBOC has quite established a philosophy to diversify their state, reserve. And so if there's necessary, and definitely they will take actions, and then they will publish the data. So we of course have for the PBOC side, we have provide all the market research data continuously to the PBOC, and also I think they, from our contact, they have fairly quite in-depth knowledge about the global gold market. I believe they have their own agenda, so I can't judge based on their behalf. I hope they can. Yeah.
I have another question, maybe also coming your way. So in China, we've been reading quite a lot about the new digital RMB, PBOC launching the new digital RMB, and there's a number of initiatives in the gold market for digital sort of backed gold, tokenized. And China, I think, was maybe at the forefront of this with central, as a central bank issuing a currency. Would you see potentially in the future that being linked to gold or having some impacts on the future trading style of gold market?
I think, first of all, digitalized gold definitely is quite a good, maybe the right direction for gold market to pursue in the long run. I believe gold, ETF, it's gold ETF is a kind of digitalized product, a standard product, traded and also traded on the official trading exchanges. And of course, in terms of the RMB, digitalized RMB, I think it's a totally different concept for those digitalized gold token. It's has nothing to between them, has nothing, no relationship. But of course, we're starting all the available or a new concept of digitalized gold in the marketplace, and we will definitely study that carefully and see what is the possible solution for futures gold market. But one thing is clear, so digitalization is absolutely one of the key trends, not only for the gold product development, and also for the channel and the retail sales development. And all the gold industries in China pay a lot of attention on this and try to find a way to digitalize their services and the retail channels. But I believe, I hope that there will be a new concept for digitalized gold. Whether that can be linked with the current digitalized products or not, we have to make in-depth analysis, and we can't make a judgment currently. Yeah.
Thank you, Roland. Joni, do you have something to add?
Not much to add on my side. I think in general, sort of digital assets and any sort of development of financial alternatives, I think in the very long run can be a competition for gold, particularly gold as an investment. But it's probably somewhat different in markets like China, where there is still a very strong link to having physical holdings. So that probably makes gold unique in its position as a physical asset.
Right. Thank you very much. I think we're now coming to the end of our webinar. I'd like to pass back to Taylor.
Thank you, Jeremy, and thank you, Joni and Roland, for joining us today. I hope our audience found it very informative and educational and all of those wonderful things. Back to housekeeping for me. If you had any questions and we weren't able to answer them, please email us at ask@lbma.org.uk. If you've already asked them in the chat, you don't need to send another email. We will forward these across to the panelists. We have some upcoming webinars. So as you can see on the screen, on the 18th, it will be the highlights of LBMA's 9th Assane and Refining Conference. We're holding that digitally in a week and a half, and we hope you can join if you haven't already registered. So that will be a pre-recorded of the summary session and maybe our best session. Following that, on the 25th, we welcome back Sakila Mirza for another series in our digital gold. Another episode in our digital gold series. So this time we're going to have Brent de Jong from Gcoin and Alex Holmes from MoneyGram. So if you have been following that series, that would be a very good audition for you. And I think we've got a 5th one coming up around May, so stay tuned for that. And on the 1st of April, we're going to check in with the LBMA price forecast survey review for the year. So we have Frederick Panazzuti, we have Rona O'Connell, Torsten Polleit, and Renee Hochreiter. And I apologize in advance if I've pronounced any of those incorrectly, but they'll be joining us to talk about kind of the first Q and the forecast for the rest of the year. So we hope that you can join us for those. We hope you can join us for our upcoming event. And if you do have any questions, you can always reach us on any of the social media platforms or emails that you've seen throughout the webinar. So with that, I'm going to end. So again, thank you, Jeremy, Joni, and Roland. Have a lovely evening and a lovely, lovely weekend.
Thank you very much.
Thank you very much.
Just